Got
Sorry that we didn't get that on the
It's just stuck
recording.
back there. I can't get it.
Ugh. All right. Aw. It's Gina, and it's Bev, and it's Tim, and Helen.
Can you see us? Oh, yeah, you can.
Yeah.
Yes, and it's Ron and Linda. Excellent. Hi,
How are
everybody.
you?
Good. How are you doing? Good to see you guys.
Good to see you
Good.
too.
Yeah. We got a bunch of people wanting to learn more about this one big, beautiful bill. So
Okay.
we're gonna let folks trickle in.
Gina, can I embarrass you for 2 seconds?
Oh, geez.
This is probably old news, but like literally, but I saw this when I walked in today. Did you see you on the cover of this magazine?
What?
I did not. Oh my God, what magazine is that?
Wait, hold on. I
Cute.
can't
Aren't
see it.
you so cute?
Show it up again. Which mag?
It's the SF Bay Times,
Ah,
Look at you, cover girl.
the June 26th through July 16th edition.
We know someone famous.
Yeah.
I love that. I love that.
well, shoot, you just made my day.
Cute as you could be.
Oh, yeah, your hair looks great, Gina. I love the scarf too.
Thank you. I just said I'd cut it all off. Let's just start over
Yeah.
again.
Yeah, good for you. All right. Well, like I said, a lot of people trickle in, but we've got Jamie Alpaugh and Brandon Miller here to help shed some light on kind of what we've highlighted as the most impactful thing for you all. Of course, there's a lot more to unpack. Let us know if you have any specific questions, but otherwise, we're just going to kind of give an overview of the top things that we think will be of interest to you to start. So with that, Jamie, I'll pop it over to you.
Sounds good. Thank you, Shannon. I'm Jamie Alpaugh. And then forgive me a little bit. I'm fighting a bit of a cold, so if I struggle to get my words out, apologize. And then I'm going to primarily be going through the slides here, and then Brandon's going to be chipping in with some commentary here and there.
Annoying questions along the way.
As he does.
Yeah. So the name of the bill is interesting. So it's the One Big Beautiful Bill Act was the official act, but funny enough, it was not the final name in the bill. That short version was stripped out through the Senate process. Officially, it's called an act to provide for reconciliation pursuant to Title II of House Concurrent Resolution 14. So we're just going to refer to it as the act for simplicity. But yeah, so here we go. Just a quick disclosure. Also, I should, make it clear that we are not tax professionals, but we deal with this stuff every day. So it's very relevant to us and all of our clients. So we're very familiar with the high level items that affect most people. But of course, you want to confirm with your CPA some of the strategies that we'll talk about. And just to be sure you're fully covered on your specific case. Okay, so quick overview. This bill was passed on July 4th, 2025. It was originated in the House. So be careful if you're looking at articles online. If you notice that the article was put out in May, you might be confused because some of those provisions were changed or scrapped altogether. So the House passed it, and then it went to the Senate. They made their changes, and then it went back to the House, who confirmed it, and then went on to the president to be signed. So do note that there are some things that changed, and we'll cover some of those things as we go. A lot of things affecting retirement income, estate, and family taxes. Yeah, and so we'll here we go. All right, so the big thing here was there was the big sweeping tax bill in 2017 called the Tax Cuts and Jobs Act. So it's really the main thing here is that it made a lot of those things permanent, because all of that, or a lot of those provisions were set to sunset at the end of 2025. So a lot of the things like the standard deduction was doubled, the lifetime exemption was doubled. Those things were made permanent and then actually even increased a little bit. We'll go into those things specifically, but that's kind of the main thing. And then there were some things like the no tax on tips and overtime. And then, excuse me. And one of the things you want to note is that some of the provisions will say permanent and some will say temporary. But when we talk about permanent with Congress, we're talking about small p permanent. It just means that they're subject to change with new laws enacted by Congress, but temporary just means unless Congress does something, they will sunset. So just be mindful of that, because there's a lot of these provisions start at different times, they end at different times. Some of them are permanent. So we'll kind of cover that as well. And then, yeah, some savings credits for children. Sorry, the child tax credit was increased. And then some of the way that they funded a lot of these changes was some cuts to federal spending, which we'll talk about. Okay.
Sorry.
Huh?
First of many interruptions to come. Somebody was asking if the PowerPoint will be available, Shannon? Yes.
Absolutely.
So do we send it to people, or do they have to go on the website, or how do they get the PowerPoint?
I can send it to everyone that attended, and then it will ultimately be on the website.
Okay, thank you.
Mhm.
All right. So the very first provision is the income tax rates. So we're talking about the ordinary income tax. Those were extended permanently. So there were changes to the top rate, which was, Brendan, correct me if I'm wrong, was 39.6. Now the top rate is 37, and it's been that way since 2018. And so that's just been made permanent. A lot of those things will have been made permanent. There's one minor thing in 2026. There's the first two brackets, the 10 and 12%, were expanded a little bit. So actually the 22%, which is the third bracket, will actually be a little bit more narrow. And then there was a thing where the 22% bracket started and the 15% cap gains bracket started. They used to kind of be really close together. So people would think, that was kind of the same point, but now there's actually that gap is kind of spreading a little bit more. So just in case that's something that was been on your radar, just know that it's a little bit larger of a gap now. Let's see. So then the standard deduction was also, like I said, in 2017, the Tax Cuts and Jobs Act effectively doubled the standard deduction, which made it so many more people were able to just use the standard deduction. They didn't need to itemize. I think the estimate was something like 90% of folks used the standard deduction. So that was made permanent and then increased a little bit more. As you can see, joint filers for 2025, it's 31,500, and then single filers 15,750. Okay.
I'm just gonna highlight what you just said to make sure everybody's getting it right. Like, so many more people just use the standard deduction these days, right? So if you don't have more as a single person, more than $15,750 or double that for married, if you don't have more than that, then you're just taking the standard. And that is a lot of people these days. So a lot of this stuff might not apply unless you know for sure that you're itemizing. There are a couple of things in here where whether you itemize or not, it could still benefit you, like with charity, for example. But just heads up, like you should definitely know. And if you're not itemizing, like let us know, like talk to your advisor about that just to make sure, because there probably are some things we can do where we like bunch deductions 1 year or bunch income or something like that in order to make sure that we're taking advantage of it.
Mm-hmm. Yeah, thank you for that, Brandon.
Yeah. Also, I'm sorry, before you go further, I just want to like just big picture. like this is highly like overall what this tax did is, you know, it's highly variable depending on your situation. Sorry, I'll answer a question on whether or not you're itemizing. You'll see that on your tax return. If there's a Schedule A, that's where you would itemize all your deductions. Or on the very first page of your 1040, you can see it'll say there's a place for standard deduction or itemized deductions, and it'll tell you, you know, which one you've got in that line. And I don't know, Jamie, if you even know the line number, but it's like line 10 or 14 or something on the first page. I mean, it's high up.
Yeah.
Pretty obvious.
And that's a good point, Brandon. Let me take a step back to, because everyone's kind of starting with a different level of knowledge on this area. So basically the way the tax return flows is you look at all of your various income sources, you add up all those, that's your gross income. And then there's two and a half rounds of deductions that happen before you get to your taxable income. So the first round is called your above the line deductions. And when we're talking about the line, essentially the line is the AGI, adjusted gross income. And that number is very important for the various thresholds for credits and other deductions that we'll talk about later. So the AGI is very important. So whenever we're talking about deductions, generally the above the line deductions are the more impactful ones. And those are things like HSA contributions, IRA contributions, student loans, certain alimony, and things like that. So that gives you your AGI. And then really those thresholds I mentioned, there's a lot of different definitions for those thresholds, and it's various definitions of modified adjusted gross income. So you start with AGI and you add back in certain things that you just deducted to get these thresholds. So there's so many different definitions. We're not going to go through them, but just know that that's what MAGI or modified adjusted gross income is. For most people, it's going to be the same as AGI, but just know there's a little nuance there. So then below the line deductions are what you hear of as either being the standard deduction or itemized deductions. Whatever one is greater is the one you use. And then the reason I said 2.5 rounds is because for those that have small businesses, if they're eligible for the qualified business income deduction, that's what we might call as below the line deduction, as I've heard, and I think that's pretty apt. And there's 3 or 4 new below the line deductions that were introduced that we'll talk about in a bit, and those are the things that were the tips, the no tax on tips and overtime and the auto interest deduction. So after you get through these rounds of deductions, then you get your taxable income, and it's the taxable income that goes into the tax brackets, and then that spits out the final answer, which is the tax that you pay. Go ahead, Brennan.
And just a thought, and that, like, you know, as I'm hearing you say these things, I just want to make sure all y'all know that we are more than happy to sit down and walk through your 1040 with you, because this stuff is confusing as heck, right? And I just think, especially when you're doing it away from your actual numbers, sometimes it's hard to like extrapolate, what does this mean to me? So just know, like, we're more than happy to sit down with you in your tax return and just walk through line by line, especially for those of us who, you know, outsource this to our CPA. Sometimes it's really useful to actually sit there with your own tax return and just go through it and make sure you understand, like, what is actually happening in today's tax environment, and what, I mean, more importantly, like, what can I be doing differently this year or next year to get my tax bill lower? So just ask us if you don't understand it, okay?
For sure. Okay, and then the last item here is alternative minimum tax. So this is a separate calculation that's done to ensure, you know, the people who are itemizing or have a ton of deductions aren't getting away with paying close to nothing. So it just basically, the calculation is done, and then it compares to how much the primary method of calculating your taxes are, and if that number is higher, then the difference is considered the AMT. So if the AMT calculation was $1,000 higher, then the AMT portion is $1,000. So the exemptions for that were now made permanent, the higher amounts. And we're not going to go too much further because previously only 0.1% of households were subject to this after the Tax Cuts and Jobs Act went into effect. So now some of the rules actually will make it so a little bit more, it becomes a little bit more relevant, but we're still talking very, very small percentage. Okay. Next topic is the child tax credit. So it was $2,000. It was increased to $2,200. Starts in 2025, and it's now indexed for inflation. Now, it will revert back to the $2,000 if Congress does nothing after 2028. And then the phase outs for this are $200,000 single, and then $400,000 married filing jointly. And it phases out at 5% of the amount over those thresholds. Yeah, I think that's
So it's a
it for
pretty quick phase out. Just
No, 5% actually is relatively small. So there's a 50% phase out actually.
okay.
So 5% is pretty light. Okay. Then we've got the new Trump accounts. So this is for starting from 2025 to 2028. So these accounts don't go into effect until July of 2026. So there's a lot of questions around these. So we'll just kind of talk about what we know. But there's going to be a lot of clarification that happens between now and then. But generally, for each beneficiary under the age of 18 can have $5,000 contributed on their behalf, whether that's parents or grandparents. And then employers can actually contribute on behalf of the employees to dependent up to $2,500 cap that doesn't affect the 5,000. And then basically these build up until age 18, at which time they kind of, from our understanding, convert into something like an IRA. But the complex thing here is there will be both pre-tax and after-tax dollars in these accounts, which is something we generally like to avoid with IRAs. So it is something we'll want to watch out on. We're not sure yet if you can roll them into an IRA after age 18. We're not sure about RMDs, required minimum distributions, like we do with normal IRAs, but we'll have at least 50 years to run into that from when they turn 18 to 75. And then the other component of this is there's a pilot program for any children born between 2025 and 2028. The government will seed it with $1,000. And how this election is made is still uncertain. And so there's just a lot of questions here. So that's really all we know at this point. But it could be a good option because some of the other typical solutions for children, like IRAs, are limited because you need earned income, which usually doesn't come into effect until they're a little bit older. 529s need to be used for qualified education expenses, though now there's a new provision that we can roll over some of that 529 money into a Roth IRA. So that is actually a little more appealing. That's kind of our favorite account for young children. And then UTMA, UGMAs, those, you lose control of those at the age of majority of the child. So this could be an option. We'll keep it on the radar and let you know more as we find out more.
In essence, there's nothing that if anybody's having a kid 25 through 28 or grandkids are coming along during that time period, there's really nothing for them to do right now. And in the future, there might be some planning opportunities here, but as of now, nothing to do.
Right. Okay. So one of the things that Trump ran on was that he was going to make Social Security not taxable. They weren't actually able to do that, but they found somewhat of a workaround. And the way that this works is for those over age 65, subject to phase out limitations, 75,000 single, 150,000 joint. There's an additional enhanced senior deduction of $6,000. Now that's in addition to the deductions that are already in place, which is $2,000 for single and $1,600 if you're married per person who's over 65. So it does increase the likelihood that many folks won't have to pay Social Security, but it is in no way tied to the taxability of Social Security. I think we've talked about it in previous webinars here, but the high level is you take the calculation is you take your AGI, but only half of your Social Security benefits, and then you run that through these tax brackets to determine if you're eligible, or how much of it is taxable. So that hasn't changed. That remains the same. And now, one thing I like to point out is, you know, at Brio, we use this software called Holistiplan, which is a really cool summary of your tax return. And then we can also look at kind of the visuals of, you know, what happens if we recognize an additional $1,000 of income. So whether that's through Roth conversions or, you know, or just earning more money, we can see what the marginal impact of that additional $1,000 is. So with this deduction, it can lead to a very high marginal tax rate or effective tax rate, because you're not being taxed more, but while you're increasing your income, you have to pay the marginal tax rate, but you're also losing the deduction. And so the effective marginal tax rate could be over 40% if you're in these phase outs. So this is something you want to be sure that you're mindful of if you are accelerating income. And just in general, you want to just work with an advisor, ideally, that is able to kind of look out for these things for you. Because we already have the IRMA, which is the Medicare premium thresholds. You know, we're already having to look out for those. Now we just have all these other obstacles that we have to plan around. So it just becomes increasingly important to have somebody doing tax planning with you. And now this phase out is 6%. So if any dollars over those thresholds, well, you'll lose 6% of the deduction.
Jamie, just so I'm clear,
Yeah.
because I know you talked about a lot of like kind of offshoots there, if you will.
Yeah.
The headline here, though, is if you're 65 or older, there's an extra $6,000 tax deduction for you, on top of the like 2K or 600 that already exist. And so, does that matter if I'm itemizing or not itemizing? Do I get this deduction regardless?
Correct. Yep. It does not matter if you're itemizing. So if you stack this on the already $2,000 or $3,200 if you're married and both over 65, and then add that onto the standard deduction, you might not even itemize, and you could get, I think the most is like $46,000 of deductions. So very powerful. All right. Okay. So as I mentioned earlier, the estate tax exemption was basically doubled back in 2018, and it's been increasing every year since then. So we're up to 13.6, and then that's going to actually increase even further to 15 million, and that's per person. So so two spouses could leave behind 30,000 without having to face estate tax. Sorry, 30 million without having to face estate tax. Now, keep in mind, the rate on estate taxes is 40%, so it's very significant, and that's just federal. So don't let this, you know, make you not think about your estate planning, because depending on what state you live in, there's I don't know the number of states, but you know, I know New York, Washington, Oregon, Minnesota, Illinois, all those states have some sort of estate tax. California does not. I know a lot of our clients live in California, but we have many that are not. So just be mindful of that, or if you were to relocate in retirement, something you might want to think about.
And other states,
and then
to be clear, a lot of times like the estate tax is much lower at a state level. Like it might kick in at a $1 million threshold or something.
Right. Yeah. Okay. Yeah, and so it makes things like the annual gift exclusion more important too, or not necessarily more important, but just something to continue to be on your radar that you can gift up to $19,000 per person in 2025. So, and that's if you have spouses gifting to a family, their son and the son's wife and their two kids, you could each spouse give 4 times 19,000. So it's pretty substantial. So and just keep in mind too that 15 million is a lot, but Congress could always lower it in the future. So if that is something that is on your radar, we might want to take advantage of using the lifetime gift exemption sooner than later. But for now, we're going to be at the 15 million, and then that is increasing with inflation. Okay. Now, charitable contributions. I really like this new provision. So back during COVID times, 2020 and 2021, folks were able to, without even itemizing, they were able to deduct, I think it was $300 single, $600 married filing jointly of cash charitable contributions. So basically they brought that back, but at a higher rate. So it's $1,000 for individuals, $2,000 married filing jointly. Now it does have to be cash, and it has to be to public charities. So it can't be donor advised funds. And that goes into effect in 2026. And so that's for taxpayers who do not itemize. If you do itemize, kind of go the other direction, is now you're faced with a 0.5% of AGI floor. So you can see the example down there. If they had $200,000 of adjusted gross income, and they'd have to contribute more than $1,000. Otherwise, it doesn't count on your Schedule A. Now, there's also an interesting component here where there's also an upper limit to how much you can contribute, depending on the type of company it is. If it's a public charity, I think it was 50%. They used to call them 50% organizations, but there was a provision previously that increased it to 60% of AGI limit, and that was extended with this tax bill. So there's an interesting thing here where if you exceed that amount, then you can carry forward the excess contributions to the next year, and you get the 0.5% floor back. So kind of interesting. Might be worth actually contributing more than your AGI if you're already going to be close, because then you'll get that $1,000 back to carry forward into the future.
So can I interrupt? Sorry. I just want to be clear. When there's a floor like this, because this gets lost on a lot of people. So like in this example, where if somebody donates, let's say $1,500 with a $200,000 income, that first $1,000 doesn't count, right? You're really only writing off the $500, the excess over and above the threshold. So that's why what Jamie was just saying could be important is if you're quite close, if you're giving a ton of money, it might make sense if you give, like in this example, it would have to be what though? It would have to be like $120,000.
120,000, yeah.
Right? If you gave $120,000, then that first $1,000, you would get that back. Essentially, right? You'd be able to write that off. So it does only work in kind of our more extreme scenarios, but there are times, right, when we're making like 1 year, making a really big donation for one reason or another. So it's just a quirk that's in there. I think for most of us, if you're not itemizing, it's awesome because you get like, not that it's a free 1,000 or 2,000, but it's a much easier to write those off. If you are itemizing, it's kind of a negative because they're taking away the first 0.5%. And then on do the contributions include in kind or clothing? And this is cash only. Now, like Goodwill type stuff is still deductible if you're itemizing, right? But the like gimme, the $1,000 gimme, if you will, needs to be in cash. And then Ted, does it require receipts? My answer to that is if you get audited. So I think in general, the answer is always a yes.
Yeah. Um,
Sorry,
so couple thoughts here. Sorry.
sorry, if I could just add to that, Brendan. I understand there was a thing before where you only needed for under 250. That's why I was asking about the receipts.
I'm sorry, you cut off for a hot second, but I think you're saying before it was like you only had to like do it if it was over, I forget if it was over like $500 or something per donation. I think it was, but yeah, okay. Yeah, as far as I know, Jamie helped me on this one, but as far as I know, there is nothing in there about that. And so the presumption is that you kind of need a receipt for every $2 donation.
Yeah, I'm not sure on that. I would just keep all receipts until you know otherwise.
Yeah, yeah.
So the strategy here might be if you itemize, then you might want to consider accelerating your contributions to this year when you don't have to face the floor. And then if you don't itemize, you might want to wait till next year so you can get that that deduction. If you're going to contribute $500 this year and next year, you might want to just do $1,000 next year. All right. All right, moving on.
Yeah,
Oh, go
sorry,
ahead.
one more thing, just on Ted on that one in terms of receipts. Like, listen, I've been audited, right? I mean, you're sitting across from another human being usually, and so it's like I always say, if you're doing something honestly and you've got whatever proof you have, like then I think you're fine. You know, if you're literally giving like $20 to the band fundraiser and you have like I know you, right? You're pretty organized on things. If you've got your spreadsheet that's like laying it all out, they're gonna include, they'll give you the $20 that you gave to the school fundraiser. It'll be fine.
Yeah. Okay. Now moving on to the SALT deduction, which SALT is state and local taxes. So those of us in California are probably more aware than others, than some others, just because there's higher state taxes, and then this includes property taxes. So we've been capped at $10,000 since the Tax Cuts and Jobs Act went into effect in 2018. So they went back and forth between the Senate and the House, and so make sure you're again reading the stuff that actually landed in the final bill. But the final the cap was increased to 40,000, subject to phase outs. And if you exceed the phase outs, you just go back down to the 10,000. It's not down to zero, but back to the 10,000. So this is for everyone but married filing separately, they get $500,000 as the threshold there. And for married filing separately, it starts at 250,000. Generally, married filing separately is try to avoid that one because it always gets the short end of the stick on these things. So it only really works in certain circumstances. But this phase out is at 30%, so a lot faster phase out. And it is set to be a temporary change from 2025 to 2029, so it is in effect this year. And then starting next year, they're going to increase both the amount of the deduction and the phase outs by 1% per year. And then after 2029, it's set to revert back, but I'm sure we'll have a lot of discussion before then about whether that should be made permanent or changes in some way. But because it's a 30% phase out, you could be in the 35% bracket and then losing 30% of the deduction per dollar that you go over the threshold. So that is a total of 45.5% marginal impact. So this is a really big one to be aware of. Like if you're one of the lucky folks that they're making between $500,000 and $600,000, you might want to really consider how we can reduce income in that year to be under that $500,000 threshold. Let's see. And then, the pass-through entity taxes, if you're aware of that, if you have a small business, partnership, S Corp, there is a way to basically subvert the SALT cap. So that was untouched. The House proposed to kill that, but the Senate removed that. So it is still allowed. Anything on that, Brendan?
not just the pass-through entity tax really does apply if you're self-employed, and only then in certain situations. But if it's something that you're not utilizing, like make sure you ask us about it because it's a really good workaround. And just big picture, like the salt cap getting lifted is super helpful for like, especially somebody who owns homes in California. Like this is helping you probably a ton.
Yeah, and let me circle back to the AMT that we talked about earlier. Because of this, this could cause more people to be subject to AMT. And then the other big one is for those that work at the startups that have incentive stock options. You're probably already aware if you do, but the difference between the exercise price and the fair market value, that amount is added back in for the AMT calculation. So both of those things, if they apply to you, you want to make sure you're working with an advisor to make sure you're not getting hit big with the AMT. Okay. So tips and overtime.
AMT, sorry, real quick, just a question while we're here. AMT is alternative minimum tax, and basically what it amounts to is you know if you're doing too good of a job at like writing stuff off, then there's an alternative minimum tax, like you have to pay at least Y amount in taxes. That I don't think it's really going to apply to you. Just FYI.
Okay. All right. So tips and overtime. So it's not all tips and not all overtime. So start there, but it's $25,000. Doesn't matter what your filing status is for tips, but it's for overtime. It's capped at $25,000 for married filing jointly, and half of that for all others. And now with the overtime, it's not just any amount that you got paid for overtime. It's the extra that you got for working the overtime. So if your wage is $20 an hour and you get time and a half, you get $30 an hour for overtime. It's just that $10 difference that is subject for the tax-free status, based subject to the phase outs and the 25 or 12,500 cap. Keep in mind also that income is still subject to payroll tax. It is included in AGI and may be subject to state income tax depending on where you live. And so for the tips, the business must traditionally and customarily receive tips prior to 2025. Can't be something brand new that you just change your system on, and it has to be voluntary tips. It can't be mandated as part of the service. And then also, the tips must not be earned through an SSTB, which is a specified service, trade, or business. So that is lawyers, accountants, financial advisors, musicians, artists, and other entertainers, among others, but those are kind of the common ones. And then this phase out is 10%. So not the strongest phase out, but it definitely is something to watch out for.
Question.
Go ahead.
For you know, I know this is very popular in San Francisco, but like in the included service charges and stuff, does that mean that folks aren't getting that? That the restaurant is charging, you know?
Right, it has to be voluntary for the payer. Yeah. And another thing to note here, you'll see it says below the line deduction. So again, that's below the line. That's really the best way I can think to call it, but it doesn't matter if you're itemizing or using the standard deduction. And then that is temporary change, applies from 2025 to 2028, unless the Congress extends it. Okay. And then I think this is the last below the line deduction. Excuse me. So we have the auto loan interest deduction. So it must be an American-made vehicle, a new American-made vehicle, final assembly done in the U.S. So I actually found that you can check the VIN, the vehicle identification number, and it should start with a 1, 4, 5, or 7. And then that should tell you that the final assembly was done in the U.S. And so this is up to $10,000 deduction. Again, doesn't matter if you're itemizing or not. So it's up to $10,000, and it's subject to the phase outs: $100,000 for single, $200,000 for married filing joint. And that phase out is 20%, so it's a bit steeper. And then again, it has to be a personal use vehicle, less than 14,000 pounds, so it can't be an RV, ATV, trailer. And so, not my favorite one here because, a new vehicle for someone making under $100,000 in California, they're not going to get $10,000 deduction because you're going to have a $200,000 vehicle at 5% to be able to get that cap. But it is something to consider if you're in the market for a new car. And again, the vehicle has to be purchased between 2025 and 2028.
Jamie, this maybe is a silly question, but are there, like, I have zero clue. Are there actually cars that are assembled in the US?
Yes. Yes.
There are. Okay. I don't know. Making sure.
Yeah. No, I was curious about that too at first. I was like, a lot of the most affordable new cars are not assembled, finally assembled in the US. So yeah, so the restrictions here are a little bit tight, but it is available. All right. Okay. Now for folks with small businesses, you might have seen initially that the qualified business interest deduction was increased from 20% to 23%. The Senate had that removed. They put it back at 20%, but they made that permanent. So that's for sole props, partnerships, and S corps. Then there's the 100% bonus appreciation restored. That applies through 2029. Full expensing for qualified equipment purchases. And then R&D expensing was also reinstated, applying through 2029. Anything to note there, Brandon?
I don't think so. I mean,
Doesn't apply to everybody.
Yeah, it doesn't really apply to a lot of folks, but if you do have self-employment income, and you're not one of those specialty businesses, the QBI is a big help to folks. And I don't know if Karen is still on here now, but like the bonus depreciation, that could also be a big help to folks. Like that doesn't start getting phased out until over $2.5 million of revenue. I think 2.5. So like for the folks that this applies to, for self-employed folks, these are really important changes and big potential dollars.
Yeah. All right. So there are many more provisions. We just covered a lot of the high level ones. We might talk about a few more in a couple slides at the end if we have time. But some of the ways that they were able to fund these changes were to make certain changes to Medicaid and SNAP programs. So it might mean that millions could lose coverage on Medicaid.
They stole money from the poor to give the rich.
No comment. Yeah. So yeah, and then there's additional requirements for legal immigrants with decades of tax payments could lose access as well. Yeah. So we could see some devastating impacts from this. Yeah. I think I'll just leave it at that. And it's also estimated to increase the debt by up to $2.4 trillion over the next 10 years. They also increased the debt ceiling by $5 trillion, which I believe was the largest increase ever. But most importantly, what do you need to do about all this? Work with your advisor if you have one. Get an advisor if you don't. I think Shannon's standing by with the phone if you don't have an advisor. And then I think the big thing here is when we're looking at tax planning, we want to be very careful of the thresholds, so we're not paying like a very high % of marginal income tax, whether that's directly through increased tax rates or from losing credits. And it's really hard to do all this and be aware of all these obstacles without without the tools. Like we have that Holista plan is a very good tool that we have. And I would just encourage you to ask your CPAs to make sure you're getting all the credits that you deserve, whether that's the child tax credit. That's probably one that is covered quite a bit, but there's also credits we didn't talk about clean energy credits. A lot of those are also going away. If you want to buy a electric vehicle, that one actually is expiring at the end of September. So if you, not saying you should go out and buy one, but if you are already planning to, you might want to move your timeline up and just be aware that those significant credits are going away.
I'd like to just add that if we don't already, if you use a CPA and we don't know who they are, we haven't had the introduction yet, please make that introduction so we can coordinate and be strategic on your behalf.
The thank you for saying that, Shannon. Like, super helpful to us if we're connected to your CPA, and also so that we can review tax returns and frankly, we catch mistakes in there all the time, just even like little clerical errors, let alone like strategic stuff. So the other thing is on the, I know you, Jamie, you were just talking about the car, like if you're doing an EV, that goes away September 30th. Solar or any of the like home improvement things, those have to be done by the end of this year. I personally was looking into like upgrading my solar, and the guy I was talking to is like, look, we're actually already like booked for the rest of the year. We will not take any more business. So if that's something that you're thinking about, you should like probably get on that yesterday. That is going away at the end of the year. And then there's something else, and I can't remember, Jamie, do you remember there's something else that goes away next summer around the clean energy stuff?
Yeah, there are like 4 categories of credits that are set to expire at different times. So if you're interested in any of that, definitely look that up or reach out to us.
Okay.
To find that.
Okay.
We had a question in the chat about premium tax credits. Were there any changes impacting that?
Yeah, so not directly, but through the sunsetting of the provisions, for those over 400% of the federal poverty limit, there used to be, or there is currently, an 8.5% of AGI cap that you'd pay for premiums. And so that is going to be lifted. So that could be substantial for a lot of folks who are paying those before Medicare age. So yeah, so that's definitely a big one. I think, yeah, does that answer the question? I also want to point out, we didn't have it in the slide, but for folks with the higher income that are at the 37% bracket, if you're able to itemize, what's going to happen starting next year is the impact of your itemization or your deductions, they offset, whatever the last dollar was. So if like all of your deductions, say you've got 100,000 of deductions and you're $50,000 into the 37% bracket, well, what they're going to do is they're going to say your itemized deductions, or your deductions can only offset up to 35%. The 35% bracket. So essentially, instead of offsetting 37%, it's only going to offset 35%. So it only applies to those with the higher incomes. But for that reason, you might want to consider, if you know you're always going to be in the 37% bracket, to go ahead and bring those itemized deductions forward, and so you can get the full 37% offset instead of 35%. It's kind of a complicated one to understand, but definitely reach out if you have questions on that.
And in general, you're going to get more bang for your buck if you donate or you have a deduction this year than in 2026.
Yeah.
Yep. Also, 529 plans, that changed a little bit. You want to talk about that?
Yeah, so the qualified expenses were expanded. So now you can use the money for materials and textbooks, online education materials, fees for standardized tests, AP exams, tutoring, post-secondary credential expenses, and then the annual limit was increased from 10,000 to 20,000 starting next year. So big impacts for 529s. HSAs were also expanded to include the definition for high deductible health plan. You need to have a high deductible health plan to be able to qualify for an HSA. So now they're including bronze and catastrophic plans in that definition. So should allow more people to contribute. And those are triple tax advantaged accounts. So those are some of our favorite. Let's see. There's so much more, but so there was the mortgage indebtedness limit that used to be $1 million that you could basically the interest that you paid on that, you could deduct that on Schedule A. It was decreased to 750,000 back in the Tax Cuts and Jobs Act, and that was made permanent. So that is made permanent. And then they added back in the home insurance premiums that used to be deductible, and then it wasn't because Congress let it lapse, and then it was added back in.
So just private mortgage insurance, most people like aren't paying that. It's if you put like a lower down payment down, if you're paying like private mortgage insurance, but now it's deductible again, you're saying.
Right.
All right.
What about the Social Security income? Any impacts?
I think we touched on that one. It wasn't impacted directly, but because of the increased senior enhanced deduction of $6,000 per person, fewer people should be paying taxes on their Social Security benefits. But you have to be 65 or over and under the phase outs.
Hey, Jamie, can you talk about premium tax credits again? Just like high level, what's new or different?
Yeah, so I don't know all of the changes, but I know that the big one is for folks that have substantial income that's over 400% of the federal poverty line, or 4 times the amount. And I wish I knew that amount, but I think it comes out to be like 85,000, somewhere in there.
Yeah.
If your AGI is over that amount, then currently you are capped at how much you're paying in premiums, and that's 8.5% of your AGI. So if you make 100,000, then you're over that limit. So then you're capped at paying $8,500 per year in premiums. But that cap is now going away. So then you'll be subject to the full amount. So it could effectively double, possibly even triple the amount that you're paying. There's a good website I like. It's called KFF. Just type in KFF calculator, and then that should bring you to your estimated ACA premiums, Affordable Care Act premiums. And then it does a good job of just spelling out how much should you be getting in premiums, and then what would it be without any subsidies.
And Jamie, I'm sorry, are you saying K as in like Kaiser Family Foundation?
Yeah, KFF, yeah.
Okay, all right. And then it looks like the federal poverty limit is like 15K. So it looks like 4X is 62,600.
Wow. That's not much.
Is that right?
I mean, UCI,
Well,
2 minutes.
Oh, you know what? I might be thinking the 2 household, because it depends on the household size. So yeah, and that'll be calculated on that same calculator. So,
Any other questions? I have a question for Jamie. Jamie, how many pages was this bill?
I think they said it was 900 or so.
Well, thank you for reading each and every one of them for us.
Yeah, but yeah, if you want a good laugh, just try to find the go to this website and read this, and it's such a headache because it's not just here are the rules. It's strike this from this section of the code and instead replace it with this, and it's impossible to just read straight unless it was a new provision. So it's a headache.
All right,
yeah.
One more question about Medicare premium credits. Can you repeat how the impact on Medicare premium credits?
Oh, Medicare premium credits? I'm not sure on that one. Brandon?
And I'm not even honestly sure what the question is, Paula.
Yeah, we were talking about ACA credits, where it's like you're paying for healthcare before you're on Medicare.
Right, you were talking about somehow the premiums would change and I missed the whole, I just couldn't figure out, is this a plus or a minus? Is there, do you know what I mean? Because it's like they change that premium every year, right?
Yeah, what we were talking about before really only applies to the Affordable Care Act, and so people who are going through the state insurance, the online insurances, it's not going to impact Medicare.
Okay, then it's irrelevant to me.
Yeah, you're good. Also, good to see you on the street yesterday.
Yes, it was.
Oh my gosh, I
Who's
love
that man
it.
without his glasses on? Exactly.
Love it. Love it.
All
Love it.
right.
All right. Well, if you have questions, feel free to reach out to us, your advisor directly. You can reach us at hello@briofg.com, Jamie, or myself at jamie@briofg.com, or Shannon at briofg.com. Thanks, everybody. And
Thank you.
all right, excellent. We'll see you next time.
Thank you, everyone.
Thank you.
Yeah.
Bye.